in the consolidated financial statement. So it could be a footnote that we are dealing with. So according to IAS 21, like the way we deal with all standards, initial recognition and what subsequent measurement. So IAS 21, foreign exchange transactions, the initial recognition is that we're going to be using the exchange rate at the date of the transaction to what? Translate the figure. So that's the initial recognition. Then on subsequent measurement, you have to ask yourself, are you dealing with monetary assets or non-monetary assets? Any idea about them? Monetary assets or non-monetary assets? Example? Monetary?
Monetary, maybe in the form of cash.
In the form of cash. So what will give us in the form of cash? Like trade receivables.
Trade receivables.
Is a monetary asset. Creditors is a monetary asset. So the non-monetary will be inventory, fixed assets, and all of those ones. So after the initial recognition, for monetary assets, you have to, on subsequent recognition, translate them using what? The closing rate for the monetary assets. So, and that's subsequent measure. We translate them using the closing rate. What does that mean? It means that when you now look at the closing rate for the monetary assets, there is going to be either a gain or what? A loss. And that gain or loss on that transaction must be recognized in the financial statement or in the income statement of the company. How we are getting the idea. Normally we take it to the OCI, the other comprehensive income, on that gain or loss that comes as a result of it. But for the monetary assets, that one we won't translate it. It will still be carried at the amount at the initial recognition. You get the concept? So let's look at how this question will be solved. So APLC bought goods on credit from China on 1st October 20X5 for $160,000. The currency of APLC is the Ghana cedis. Exchange rates are as follows. So we are giving for October, for November, and then December. So initial recognition. So APLC, initial recognition. So the transaction date is very important, and that is 1st October. So the initial recognition of this transaction, we will use what? The October rate. So value of the goods in Ghana cedis is going to be the $160,000. Are we multiplying or dividing? So $1 is whatever, the Ghana cedis.
Yes.
So $160 will be, so we multiply.
Yes.
So we multiply by 5.5. 5.548.
No, 5 point.
Okay, yeah. 5.432. So what do we have?
869.
869.
120.
120. So that is the value of the goods now. So what is the double entry for the initial recognition? Remember, we are buying goods on credit, so we debit our inventory with 869,120, and we bought it on credit, so we will credit what? The supplier or trade payables. 869,120. Are you getting the idea? So that is the initial recognition. Now, the inventory is a monetary asset. Sorry, non-monetary asset. And the trade receivables is what? A monetary asset. So if, as at the end of the year, the company has not paid their money, then the monetary asset will have to be translated into the financial position using what? The closing rate. But for the non-monetary asset, that is the inventory, it will still be carried at what? The initial amount.
Okay.
Are you getting the distinction? So let's look at the subsequent measurements. So subsequent measurement, we will say that the trade payables is translated to statement of financial position using the closing rate. So what will be the value for trade payables now at the closing? 160,000 by 5.832. So what do we have?
933,120.
933,120. So what is happening here? Are we owing more or owing less?
At the moment we are owing more.
We are owing more. So because we've not paid the money yet, we are owing more. So we're going to find out exchange loss. And that's going to be 933,120 minus 869.
That's 120.
120. So what do we have?
64,000.
64,000. You got a picture? So now this exchange loss must be recognized in the statement of what? In the other comprehensive income of the company. So if we are answering the question, it says how should this be accounted for in the financial statement for the year ended this? So these are initial recognitions and subsequent measurements. So the real thing is how should they account for it? So now we prepare our extracts. So income statement and OCI. Now, since it is a one kind of transaction, we'll go straight to OCI and then we'll bring exchange what? Loss. From our workings, that's how much?
64,000.
64,000. Then when we go to the balance sheet, statement of financial position, two things are going to be there. Under current assets, we're going to have our inventory, which will not be translated. So we will still use the initial value. So 869,120. However, when we come to the current liability section, we're going to have trade payables. And we'll now use what? The new value we had. 933,120. That's it.
But the questions ask us to account for the month of October.
For the year, how do we call it? For the year ended, it's for the year ended 31st December. Okay. That's why I use the word, the year ended, they've not paid the money yet. Okay. Are you getting the idea? So for the year ended 31st December 2015. So because the year ended, they've not paid, that is why this exchange loss is going to come in. So if it was a gain, it would have been recognized also as a gain. But the difference is that the monetary item, which is the trade payables, will be carried at the closing rate in the statement of financial position. But the non-monetary, which is the inventory, you will still use what? The initial value. You get the difference. So that is it about the issue about the IAS 21. So always, that's all. So at the end of the day, we will buy, so it's just brought, but you're not going to use it. All you ask is, what's the opening rate, what's the closing rate? That's all you're interested in.
I was trying to do this financial management.
This is financial management, there's another thing. We are doing hedging and those things. Students don't like it, but come back.
I'm writing it.
Oh, okay.